The information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate having regard to your objectives, financial situation, and needs. So today I'll be joined by Ryan Levin and Dani Peer from Wingate. Ryan Levin is a managing director of property at Wingate. Ryan is an actuary specialising in risk management and financial structuring. He has spent 2 decades in financial services, holding roles ranging across product development, financing, and property. Ryan has business building and investment experience across 3 continents and brings substantial marketing, innovation, analytical, and entrepreneurial skills to Wingate, as well as specific experience in finance, insurance, and loyalty industries. Prior to joining Wingate, Ryan founded Destiny Health, a Chicago-based health insurance company, spearheading what is now commonly referred to as the consumer-driven healthcare sector in the US. Dani Peer is also a managing director of investor services at Wingate. Dani has over 20 years of experience in the investment industry and financial markets, primarily focused on optimizing the structure and operational flow of professional advisory practices. His career has included senior roles at Zurich Financial Services, Australian Financial Services, and at the National Australia Bank. He is regarded as a thought leader in the investment advisory business, specialising in business growth strategies and client engagement solutions. So with that introduction, I'd like to hand over to Ryan and Dani.
Cheers, Kane. Thank you very much, and thank you for inviting us to your series. Ryan and I have been looking forward to this presentation. Just another disclaimer, I do hope that everyone who's watching can tolerate 2 South African accents for the next 60 minutes or so. We were going to use subtitles, but in lieu of that, we'll just speak slowly. But we just ask for your patience and tolerance, and hopefully your accents won't change that much when we finish in the next 60 minutes or so. The way Ryan and I thought we'd present to you today is I'm going to hand over to Ryan in a minute or so just to make a few opening comments about Wingate, a bit of background to Wingate and who we are. Ryan will pass it back to me then, and I'm going to focus on our view, our house view of the macro situation, the environment in which all of us operate. Very important from a Wingate perspective that we understand the landscape within which we are moving in and creating investment opportunities within. That'll take, I suppose, about 15 minutes or so. I will then hand it back to Ryan to specifically talk about Wingate opportunities and how we respond to the circumstances that we find ourselves in today. And we'll hand it then back to Kane, and look forward to any questions from you. So we'll be talking, Ryan and myself, for about 30 minutes, and then we'll certainly have about half an hour for questions. So let me hand it to Ryan to give everybody a bit of background to Wingate. Ryan, over to you.
Thank you, Dani, and thank you, Kane and Hamilton Wealth, for hosting us. As Dani said, I'll give you a brief overview of Wingate, who we are and what we do, and then hand back to Dani for a general environmental and macro overview. Wingate is an investment house. We invest first and foremost our own capital alongside our co-investors. We have 3 primary businesses. We have a property business that invests across the capital structure, so from senior debt to mezzanine debt to equity, joint ventures, and direct property investment. Most of what we'll be talking about this morning will focus on the debt aspects of our investment. So property is the first of those businesses. We have a corporate investments business, which is primarily a lender to businesses. A particular focus of our corporate investments business is lending to lenders. So we understand the lending space very well, and providing funding lines to lending businesses is a particular area of expertise, though our corporate investments business is far broader than that. The third of our operating businesses is Now Finance. Now Finance is a consumer lender, and provides consumer loans really in competition with the big players in that space, which are the banks. So these are direct-to-consumer personal loans. So those are our primary operating businesses. We also are quite excited that we have just launched a new mortgage business called Ord Financial, that's we're really excited about the non-bank mortgage lending space, which Ord is really well placed to access and start to take market share in. To come back to what I view as the really two core principles on which Wingate operates, and this really defines how we run our business and how we invest. These are our perspective on risk and partnership. So to talk a little about each of those, our view of risk is that always comes first. The first lens through which we consider any opportunity as a risk lens. Unlike others in the space who might consider the risk, price it, and pass it on to someone else, if we don't get comfortable with the risk, we simply don't make the investment. So being comfortable with the level of risk that we're taking is the very first consideration. And only if we are comfortable with the risk in a particular transaction do we proceed to considering things like returns. So risk is very much first and foremost in our minds. Partnership, to touch on that, we are very much a partnership focused business, and that has a number of dimensions to it. I used the term earlier, co-investors. We view our investor clients as investment partners, because everything we do, we invest in ourselves, and by ourselves, I mean Wingate balance sheet is invested in every investment that we make, as well as our executives, directors, and shareholders co-invest in Wingate investment product. So our co-investors are truly partners on a pari passu basis, exactly the same terms, exactly the same part of the capital structure. But the partnership concept applies in other dimensions too. And one I'll focus on is the relationship we have as lender to our borrower clients. We view our borrower clients as partners too. And what I mean by that is that our ideal outcome from a debt transaction with a borrower is that the borrower does well out of it, we do well out of it, and our co-investors do well out of it. So truly a win-win-win. What that means practically is a few things. One, we are not a lender of last resort. We are not predatory in our lending. We don't do loan to own. So what loan to own means is where a lender will provide debt secured against an asset that they hope to ultimately take ownership of because the borrower defaults or is unable to repay them. That's simply not the Wingate approach. So partnership applies and what it also practically means is that we do a lot of repeat business. We look to establish long-term repeat relationships with our clients. Partnership also applies at other levels. So we look to our service providers, accountants, lawyers, etc., to help us grow our business, and we look to help them grow their businesses. So it truly is fundamental in what Wingate does. With that, I'll hand back to Dani to get into some philosophy and detail on the macro environment.
Yes, thanks, Ryan. And I suppose really the first half of what I'm going to say is fairly philosophical, because I think it's obviously very, very important for each producer of products, every fund manager, to have a general view on what the environment looks like. And look, there's just so many opinions out there, and there's good thinking and there's bad thinking, and there's thinking that goes along with the flow, and there's some independent thinking as well. We'd like to see ourselves as independent thinkers. We'd like to see ourselves as people who ask difficult questions. And sometimes, in fact, quite often, our CEO, Farrell Meltzer, makes the point that sometimes it's just important to ask yourself the question and think about the question and not necessarily land at the answer, because sometimes the answer is just not simply available. And the two key themes that I'd like to share our thinking with you on this morning is one being uncertainty and the other being valuation. And this thinking does occupy our conversations and our thoughts at the moment. And as you'll see as I go through some points, we haven't quite landed in certain areas, and nor indeed do we need to land in those areas. We just have to make sure that we are looking and seeing as objectively as possible how the general investment environment is evolving, and therefore feed that thinking and that awareness into what opportunities we are offering our investors. So on the first theme, theme of uncertainty, what is making us uncomfortable? What are we seeing out there? Uncertainty is a word that's been bandied around quite a bit this year with the whole COVID overlay. But specifically, where are we seeing uncertainty and what does it mean? So the first thing we look at is really what's unprecedented credit creation. That won't come as news to many of the people on this video call today. But what does it mean? And in particular, with the degree of credit creation that we're seeing, why are the bond vigilantes or bond yields as low as they are? Again, we've got several $1 trillion. The number tends to move around somewhat, but as of last measurement, there's between 12 and 14 trillion dollars worth of mainly sovereign debt that's trading at a negative yield when fiscal policy is more and more aggressive, and there's more and more credit that's being created in the system, and yet there's this comfort amongst holders, particularly holders of long-dated paper, that this is not going to turn into inflation, and that the value of money itself doesn't seem to be eroded by the level of interest rates that we're seeing at the moment. And historically, this doesn't add up. Historically, this doesn't make sense. Something has to give. Obviously, there's a fork in the road. Potentially, the bondholders are suggesting that we could move into a deflation situation, which means very low or zero interest rates are good. But then, of course, there's a camp that says, well, this is going to stimulate and fire up inflation. And the interesting thing at the moment is, and again, part of our uncertainty thesis, is there's no definitive direction in that fork in the road. It could be either. It could be deflation now that the economies are weak and inflation later. But that in of itself creates additional questions about somebody has to hold all this credit. And if inflation's going to come in at some stage, whether it's 2 years' time or 5 years' time or whatever, somebody has to hold that paper. So is there going to be a kind of a hot potato thing cropping up in a few years' time? We don't know, but we're very mindful to watch how this situation evolves. The second area that we're looking at with regards to uncertainty is the unprecedented level of interest rates. It's just extraordinary if you look back at last Tuesday to think that during our lifetimes and everything that we've learned from our textbooks and so forth, that the Reserve Bank of Australia would be cutting rates from 25 basis points to 10 basis points. It's just unheard of. It's something that we would never have guessed at a few years ago, and yet here we are at ZIP, zero interest rate policy environment. But the question is not so much that it is, because it is where we are at. What are the consequences? What are the implications of having no safe yield available in the investment system? Many investors need income. Retirees need income. Foundations, charitable foundations need income. How do these organizations position themselves in order to generate an income? What you could do, and what a lot of people are doing now, is selling capital or selling capital gains to generate that cash flow. But that can only be done in a small group of people. It can only be done on a small basis, because if everybody starts cashing in their capital gains in order to generate some cash flow for whether it's a retirement or charitable purposes, whatever the case is, well, that doesn't work, because then values start going down and you start getting a self-reinforcing locking in losses. So again, we ponder, we think about how this is going to resolve and how that the implication for what we do. Another area that we find particularly interesting, that we're watching with a great degree of attentiveness as well, is the new panacea for fiscal policy. Suddenly, governments can rescue the situation. That running major deficits is a good thing because it somehow rescues a society from bad things. And we hear more and more credibility being given to a particularly what we consider egregious part of economics called modern monetary theory, which proposes that there is actually no credit limit to a government, that whilst the household credit card has always got a limit, that governments working in concert with their central banks have got no limit. The problem is, of course, is that history shows that large government involvement in the economy is very detrimental to the economy. You know, socialism went out in the early 1990s. Central planning is viewed generally as bad, and yet somehow our shift in perspective, our shift in focus says that fiscal deficits, big, large, massive fiscal deficits at the moment are somehow a positive and will get us out of the situation that we find ourselves in now. Well, it's never worked before. We remain open-minded, of course, but it's never worked before. So what are the implications then for general asset classes and the economy in general? Another area we look at is the collapse of productivity and wage growth. I sat on a call a few days ago with a particular senior policymaker in Australia, and the expectation is that wage growth inflation dropped below 2% now, probably close to 1%. That's very, very problematic for aggregate demand. It's very, very difficult for economic growth when there's simply no growth in the aggregate demand of the economy itself. You know, interesting enough, we pat ourselves on the back and we've been very proud about Australia's unblemished or very, very long period of GDP growth. You know, nearly 30 years of GDP growth from the early 1990s. But that only is a good story if it's looked at in aggregate. What there has been regular bouts of per capita GDP recessions. What I'm saying is, if you have a look at the growth from a country itself, sure, that's been positive quarter on for, you know, almost going on for 30 years, just stopped. Of course, we're now in a technical recession with COVID, but things look very, very positive from a high level. But we look at it in a bit more thoughtful and a bit more granular way, in that there has been a stagnation in Australian wages. And again, if you measure it per capita, we've had a lot of periods of negative growth in Australia. It's just our massive immigration program that when you add the number of people in the economy multiplied by the output of those people, it's a continuing positive story. But drill down, scratch the surface, and it's not that good. It doesn't look that good. Couple more points before I move on to the other key theme of valuation, is the increasingly narrow participation we're seeing primarily in equity markets, but quite a few markets generally. What I mean by narrow participation, I mean that whilst indices have been going up, equity indices, and you know, only recently intraday we had the Dow and the S&P at a record high earlier this week. What we're seeing is we're seeing narrow and narrow participation in those markets. In other words, there's a few big shares that are going to new highs, but there are a lot of shares that are nowhere close to new highs, and in fact, a lot of shares hitting new lows. That is an indication of the fragility of the economy. That's an indication as well of the challenges to everyone on this call as to how to invest their assets in order to make a constructive return on those assets. Bear in mind that everybody has to hold every counter in the S&P 500 at any one point in time. Those who are holding FANG stocks are smiling from ear to ear and doing fantastically, but every counter has to be held, and people holding other counters aren't doing that well at all. In fact, these markets, I'm going to go through a few numbers in a few minutes, markets that haven't gone anywhere for a considerable period of time. And the last area that we're looking at that's introducing a large degree of uncertainty is technology disruption. You know, people are saying that the COVID period now has accelerated the impact of technology in our lives by about 5 years. I mean, just this communication that we've got going now and the utilization of Teams and Zoom and Google Views and other technology to get people face to face, this has been enormous. We've now adopted that as almost standard in our business. There's been other massive technology disruption in the forms of afterpay and pay later mechanisms and so forth. And who are the winners? Who are the losers? What is that doing to the economy? These are questions that we ask ourselves. And all of the points that I've made up until this point introduce a great degree of uncertainty for the investor. And it's something that we keep mindful of, and it's something that occupies our thinking, because you've got to look out in order to construct good opportunities within a fund manager. Brief comments about the four major asset classes before I have a look at valuation. Cash, negative real returns now. So cash gives you optionality, it keeps you flexibility, but the days of hunting for a great interest rate and parking cash for several years because that's the safest place to get yield looks like a thing of the past, and looks like a thing of the past for a considerable period. Having a look at property, well, COVID has really disrupted property. They're winners and they're losers. And the economy and the strength of the economy emerging from COVID as well. And again, it's not just COVID that's impacted the Australian and world economy generally. We came into COVID in a pretty weak situation, all in all, from a world environment. So it's not just COVID that's impacted property. It's again the ability of the tenant to pay the kind of rentals that have given property the kind of values that we're seeing now. Who are the winners? Who are the losers? That's still to evolve. But believe you me, we've all got a very sharp look and eye out for how the property market itself is going to evolve in these current circumstances. Looking at bonds, well, bonds have been described by places like Macquarie as a return-free risk. And bonds have to be looked at very, very carefully now, because if there's a smidgen of inflation that comes into the system, and we all know that the central banks are working very, very hard to introduce some element of inflation, well, you can't have the American 10-year bond, the absolute bellwether cornerstone of the bond market, trading at under 1%, and American inflation sitting at 2% plus, where Mr. Powell's indicated he'd like to get it, because you're simply going to lose 1% each and every year that you hold that particular instrument. So where bonds go now, the inverse correlation that they used to have with equity, the utilization in portfolios in order to introduce that inverse correlation and that balance that in bad times bonds would perform, in good times equities would perform. Well, that's been a thing that's lost its inverse correlation. How does it influence portfolio construction and so forth? These things are still evolving. And finally, and this will lead me into my last few comments about valuations, is equities have been described as showing good value with some commentators and an absolute roaring bubble with other commentators. And I think just to leave the topic of uncertainty, that probably is a key indication to the degree of uncertainty in the system at the moment, that you've got very, very experienced fund managers managing tens of billions or hundreds of billions of dollars of investments that are on opposite sides of the coin in key expectations of the future. Deflation, inflation, equities well priced, equities woefully overvalued. And that uncertainty now is the biggest, that set of uncertainties that I've described now is the biggest challenge now to fund managers in general and certain investors in understanding how they're going to allocate into which asset classes they're going to allocate. Few comments on valuation. I'll park uncertainty now and let's talk about valuation. So valuation, and I'm specifically focused on equities now, valuation in its most basic form is getting the cash flows right, discounting it by an appropriate discount rate and saying, all right, this is the appropriate value for this particular equity to trade at. But some comments around those two parts of the equation now. Let's have a look at the numerator, the cash flows. The interesting thing about current cash flows is that we're seeing the greatest, largest margins in the history of capitalism at the moment. That sounds a bit of hyperbole, but it's just about right. When we say margins, these are the margins that the major companies, the major corporations globally are operating at. Why are we seeing such great margins? We're seeing great margins because of several tailwinds, inputs into the margins of businesses. Number one, technology. That was such a massive cost saver and continues to be a cost saver and simply flows down to the margin in a business. We've seen globalization create huge savings for businesses. Farm it out to low-cost areas and just bring it back, maintain the margin or increase the margin by just getting things manufactured at lower prices. Of course, we've seen the lowest cost of debt. That's going to flow into the margin straight away, just simply paying less for the gearing in the business. And we've seen the insidious effect of share buybacks as well. This has slowed down somewhat in the COVID period, but the impact on share buybacks, again, means that there's less shares to dilute the cash flows, and this just goes in another boost for earnings per share. So we see cash flows now at what could be construed as a maximum or at a very high level. Why? Because a lot of this is starting to reverse now. Technology will continue to contribute positively, but that big step up that we saw in technology, that's now flattening somewhat in the ability to contribute to businesses' margins. I'm talking generally now. Globalization may even be reversing with COVID, and the realization in COVID of the fragility of global supply lines. You're not going to get debt costing much less. So there's a very good argument, I'd suggest, to say that margins have peaked and that margins could very well decrease as labor starts to assert its influence over capital again as well. Again, I spoke about flat wages frankly, in Australia, it's been flat wages for a couple of decades now. I just don't think this is sustainable. We need to be able to spread the benefits of capitalism in a much more broader base, not only for aggregate demand, by the way, in order to provide the strength to GDP, but certainly because a society is simply not accepting the have and have not equation that this kind of dynamic has introduced. What we're seeing now is we're seeing shareholders and we're seeing entrepreneurs having an enormous slice of the output of an economy, and more workers, blue-collar workers, getting a shrinking and smaller amount of the benefits of the economy. And this really, and I'm not going to digress over here too much unless these questions, but certainly this flows into the kind of politics that we're seeing now, which is becoming more and more fragmented, more and more strident, more and more us versus them. And that's an unhealthy situation to be in, and most likely will be reversed back to some extent. Already the Democratic Party is one of their key principles is the reverse of tax rates, the tax cuts that Donald Trump implemented a few years ago, which in and of itself is going to cut the cash flows. So talking of value now, the cash flows are at a peak, and there's no doubt will come down in some way. And you have a look at the discount factor, and of course that is very, very narrow because we've got historically low interest rates, and you add whatever premium you want for the discount factor, we're ending up now at a very high value situation, arguably. And if we have a look at how people measure value or the technical measures of value, obviously the classic is your price earnings ratio to get a sense of how many times, how many years are you paying for a set of earnings. The PE ratio really is a very blunt tool. Robert Shiller came in about 15, 20 years ago with what he called CAPE, the cyclically adjusted price earnings ratio, which took account of some form of the business cycle, and that shows even higher PEs. And of course, probably the innovation that I've got the most respect for and I pay the most attention to is a measurement that was innovated by a commentator by the name of John Hussman, and that's called the MAPE, the margin adjusted price earnings ratio. And the margin adjusted price earnings ratio takes cognizance of the factors that I just mentioned over the last few minutes. And if you want to have a look at the MAPE, it's at the highest value almost ever. It's as high as 1929. It's slightly below 2000, simply because in 2000, if you recall, in the dot-com boom bust, there were a lot of companies that actually weren't making any earnings whatsoever. There were multi-billion-dollar companies with no earnings whatsoever. So that was, I think, an aberration that gave a particularly high valuation on the classic methods. But if you have a look at now, measuring the Dow, S&P 500 and so forth, it's very easy to argue that equities are at very, very high values. And what does this mean? And I'll stop now in a couple of minutes. What does this mean? It means that if you buy equities at an inappropriate to too high a value, it becomes a pretty poor investment. There's a great saying that a great business bought at a too high price is a bad investment, and that's the absolute truth. So just a couple of examples of numbers. I'm going to end up in a couple of minutes just talking about where we see a solution to this set of circumstances that I've described. When did investors buy at a too high a value, and how's it worked for them? Well, just some numbers to share with you. If you were an investor in the Nikkei, primarily a Japanese investor, but of course anybody could invest in the Nikkei. The Nikkei now is approximately 25,000, the index. It was 25,000 in 1991. So 29 years of no growth. You buy at a too high a value, and what it translates into is an absolutely no growth circumstances whilst the fundamentals catch up with the value. But that's the Nikkei, 29 years no growth. If you have a look at the London Stock Exchange, the FTSE was 6,000 in 1998 and crossed 6,000 last week. So 22 years no growth in the London stock market. I'm obviously excluding dividends over here from those two comments, from all my comments over here, but dividend yields tend to be very low in those markets. And of course, our own ASX, let's bring it home, was 6,500 in 2007 and 6,500 now, 13 years later. So the bottom line is, if you invest where in a circumstance where the value is too high, that tends to be a very, very poor investment. I'll finish in a minute now just talking about our particular asset class, and then hand over to Ryan to provide some color as to how we go about investing in our particular asset class, which is primarily secured private debt. Secured private debt basically solves both uncertainty and valuation to a great extent. Not perfect, nothing's perfect, but it solves for both the uncertainty conundrum that we look into and the valuation conundrum that we find ourselves with. When it comes to uncertainty, secured private debt, certainly with Wingate, is short dated. So there's no duration risk. In other words, interest rates can go up due to inflation, whatever circumstances, and there's hardly any impact on the value of secured private debt, because if it's got a short, if it's repaid within a couple of years, then changing interest rates have got no impact on the capital value. Whereas that's not the case, of course, with long-dated bonds like Australian government bonds, US 10, US 30, and so forth. The second advantage of secured private debt I'd like to share with you is that it's private, it's unlisted. So there's no volatility, or very little volatility in the underlying investment. And I think volatility really, this 2020 was a year of volatility, with all the discomfort and unpleasantness that volatility introduces into an investment portfolio. Again, going in with the uncertainty, the nice thing with the debt as well, it's got headroom. So when things change, when markets move, when valuations change and so forth, debt is protected by a profit level and by an equity level before there's any kind of influence and impairment on the debt, on the investment in the debt. So having the space in order to accommodate valuation uncertainty and so forth is very positive for a debt investor. And the fourth comment I'll make in uncertainty is that secured debt has got a plan B. In other words, if the person that you lent the debt out to, the counterparty, if they can't pay it back, you've got the comfort of knowing that there's security, you attach the security and you sell it and you recover all or most of your debt if you've got that security well structured. Last comment I'll say on the valuation side is secured private debt, because again, it's not on a market, is purchased and sold at the net asset value, or what's expected to be the net asset value. So there's no market premium, no market discount. WYSIWYG, you get what you see. And the final point I'll make is that in the whole hunt for yield that we're seeing at the moment, and very, very compressed interest rates and difficulty obtaining yield, is that the illiquidity associated with secured private debt translates into what are in some cases a significant illiquidity premium. So investors are really rewarded by a significant upside in the yield, because the debt itself, being private, is not easily traded. So that was quite a fire hose of comments and so forth, and may have provoked one or two responses from you, and I'll certainly welcome some questions later on. But let me stop now and let me hand it over to my colleague Ryan Levin to drill down and specifically see how Wingate constructs our secured private debt and why we believe it's so appropriate in these circumstances. Ryan, over to you.
Thank you, Dani. Forgive me, Dani, because I'm going to distill what you've said into one word, and that's uncertainty. We absolutely are living in an uncertain environment. This year, I'm sure for all of us here, has been more uncertain than most. And it's been a bit of a roller coaster. The extent of uncertainty has shifted over the course of the year, but without question, we're in an uncertain environment. Where that's heading and what the outcomes will be remain uncertain. Dani's articulated very well how secured private debt addresses that uncertainty and is able to provide investment returns in an uncertain environment without taking on excessive risk. That's something that Wingate's been doing since really the beginning of Wingate 16 years ago. It's always been a core focus of ours, but we now find ourselves particularly well placed to be providing the sorts of investment returns that we have been able to provide in the past, but in a very uncertain environment without taking on additional risk. So to get into a little detail as to what we do and how we do it, there are two particular areas in which we invest in secured private debt. And as I mentioned earlier, that's property secured debt and corporate secured debt. We have a fund called the Wingate Investment Partners Trust, which is our flagship fund. And that really is a portfolio of Wingate proprietary secured private debt investments. As Dani said, each of those private debt investments has its own security structure. There are really three things we look at when we consider a debt investment we make. The first is, who is the counterparty? So who is it that we're lending to? Who's our borrower partner in the transaction? Do they have the requisite skills, experience, capability, financial strength, etc., to deliver on whatever it is that they're doing and that we're providing the funding for? The second is the underlying security. So what are we taking security over? If it's a property, for example, all of the obvious considerations, location, of course, but what is the underlying property? If it's a property development, what is being developed? How does the product that's being developed fit into the local market? What's the competition in that market? What's the access to amenity, transport, etc.? Does the scale, size of the individual units, if it's a residential development, fit with the local market demand? All of those considerations come into it. So underlying security is our second core consideration. And the third is exit. How do we get out? It's all very well to lend money, but until you get it back, you haven't made a successful investment. So those are our key considerations, and we've done now probably close to 300 transactions in the debt space in Wingate's history. So we have a lot of experience in considering those specific aspects and determining which make sense and which don't. That doesn't mean we always get it right. And I'll talk in a couple of minutes about some of the areas where we've experienced some difficulty and how we've worked through those. But what it does mean is that we have very substantial experience in identifying the key areas to focus on. So each of our private debt investments, we believe, given the security that we take and the due diligence we do on that, it's a higher return than is warranted by the risk that we're taking. When you take a portfolio of those private debt investments, a basket if you like, you get the additional benefit of diversity. That diversification within the portfolio means further reduce risk. And to the extent you're able to keep your portfolio deployed in investments within the portfolio, when they mature and exit, have the ability to feed new investments into that portfolio, then you can maintain your overall returns with substantially lower levels of risk. The Wingate Investment Partners Trust Fund is exactly that. It's a diverse portfolio of debt investments, currently stands at around $1.1 billion and has in aggregate about 60 debt investments in the portfolio. And each of those is structured and very much in a bespoke way, as I've described. To give you a bit of perspective on what that portfolio looks like, as I mentioned, it is a portfolio of typically around 60 individual underlying positions. The majority of those are secured by a real property, and the majority of those are secured by first mortgages over that real property. So we take, as Dani said, we consider the macro environment and each of the micro environments in which we operate and take a view as to where we think we're going in that market and the potential risks and volatility in each of those markets. What that's meant for our portfolio over the recent years is that we've shifted the mix of the portfolio in two important respects. The first is the extent of senior debt in the portfolio. 5 or 6 years ago, the majority of the WIP portfolio was mezzanine debt, which is where we saw a really good opportunity from a risk return weighting perspective. But we've very decidedly transitioned the portfolio towards senior debt to the point where today the WIP portfolio is more than 80% in a small amount of cash and senior debt. So very strong weighting to the more secure end of that spectrum, the most secure end of the debt spectrum. The second area where we've decidedly transitioned the portfolio is to lower levels of gearing. So Dani spoke about the fact that there's a buffer, some headroom when you are lending. If you look at the weighted average gearing of each of the underlying WIP investments, that stands currently at about a little under 65%. So what that means is on average, each of those underlying debt positions is geared to 65% of the value of the underlying security asset. So in the extreme, if the market were to fall by 35%, so the value of the underlying security were to fall by 35%, our debt position would still be whole, and that includes the return, the interest on our principal invested. So that really describes the WIP portfolio. WIP is a unit trust, and investors participate in the unit trust by holding units that each have a share of that whole underlying portfolio, so get the benefit of diversity. WIP makes quarterly distributions of the income in the fund. Historically, that's been in excess of 10% per annum. In our current market, as Dani said, interest rates are at a really all-time low. We're anticipating high single digits on a go-forward basis, and that's a function of, one, the much lower interest rate environment in which we're operating, and two, our very core focus on lower risk investments, senior debt, and lower levels of gearing. But we believe we're very well positioned on a go-forward basis to continue to produce risk-adjusted returns that are far in excess of the level of risk that's being taken by the underlying fund. I think I'll leave it at that to give us some time for questions, and can hand back to you to facilitate the Q&A.
Thank you very much, Ryan and Dani. So we've got a few questions already. So the first one from Michael Stillwell, he's asked, do you forecast any significant market corrections as 2021 evolves? And do you have any thoughts in relation to industrial real estate, for example, factories and warehouse valuations?
Ryan, do you want to tackle the first half and I'll leave you with the second half?
Perfect, Dani.
Michael, thanks for the question. Look, anybody who predicts a serious correction or any material pivot in the market, you need to maintain eye contact and gently back out the room and then run. It's not possible to predict. The degree of interference and dare I say manipulation and central authority involvement in financial markets now is again, using that well-worn word, unprecedented. So the only comment I'll make is that can an overvalued market, assuming that indeed it is, go higher? Absolutely. Do overvalued markets look to correct and find more value? Absolutely. But I just don't think that trying to anticipate the future and, time your entries or exit has ever worked in the past, and I doubt it will work in the future. And I've worked for many years with Will Hamilton and John and his team, and all I can say is the approach that they take to investing, diversification, application of value overlays and so forth, and then just sticking in the time in the market and sticking resolutely to a plan. That's the only solution and tactics that I've ever seen work. But I'll leave Ryan to talk about the actual markets in that second part of your question.
Thanks, Dani. The second part of the question relates to where we see the industrial property market. That certainly has been a space of most of the property submarkets that has been positively impacted by COVID and what we're seeing going on in the economy. The need for industrial space has really taken over from a lot of retail, as lockdowns have resulted in a lot of online shopping and virtual shopping. The industrial sector has taken up that slack. So industrial real estate is very much the flavor of the month at the moment. I don't mean by that we anticipate it's going to go out of favor. I think there are very strong fundamentals in that space. In fact, Wingate has an equity joint venture in the industrial real estate space that we're very excited about. That's something that was identified with our joint venture partner probably about a year ago now, and we're progressing that development and very excited at the opportunity there. So it is a space we've been watching carefully and continue to watch. We do have a portion of our debt portfolio exposed to the industrial space and are very comfortable with that. Just perhaps to touch on some of the other sub-markets in the property space while I have the floor, and can shut me down if we're running out of time. Residential real estate has been an area that we've had a particularly strong focus on. That remains an area that we are strongly focused on, and we really do like the fundamentals in the residential space. That said, as I mentioned earlier, our level of gearing has been reduced, and we've very much focused on senior debt positions to create a buffer between the market and ourselves. Retail is certainly an area that's being closely watched by everyone. I think the retail property space has been one of the hardest hit by the shutdowns that we've had, and certainly smaller retailers are in a lot of pain. We'll only start seeing and feeling that, I believe, as the stimulus starts to roll off, and that's a space that we're watching carefully and frankly quite concerned about. Hospitality is an interesting one, because hospitality, hotels, etc., have been particularly hard hit by the shutdown in travel, closure of borders, etc. But that's a space that we expect to rebound quite strongly. We believe that the local travel market, domestic travel, will be substantially higher than it has been historically, given that the local population can't currently travel overseas. And we actually anticipate that will more than outweigh the shortfall inbound international travel. So hotels and hospitality is a space we're very interested in and watching very carefully, and are looking at playing in that space. Obviously, as I mentioned earlier, subject to very careful risk considerations and ensuring that we are well protected.
Great, thank you for that. We've got another question from David Wills. So Wingate was an early mover in the alternative to bank lending market. So firstly, with so many newer entrants, how are you finding competition for deals? And secondly, is there sufficient active government regulation to ensure the whole market continues to have a credible reputation?
All yours, Ryan.
I'll take that, Dani. There's a number of sub-questions in there, and some very interesting concepts and thoughts there. I think from a overall competitive perspective, Wingate as non-bank lender is playing in a space that is, to a large extent, the gap that's left by the banks. So we don't typically compete with the banks, but we fill in the gaps that are left by the banks. And what I mean by that is that the funding that Wingate and other non-bank lenders provide is typically funding that the banks can't or won't provide. So in some cases, it's slightly higher gearing levels. In other cases, there's less clarity as to exactly where the exit comes from or how the facility is going to play out. And so our ability to be bespoke and flexible, our ability to understand the specific circumstances and provide a bespoke debt structure around those circumstances is really where we operate. Now, the environment that we're in is one where the banks have been under substantial pressure to reduce their lending and to tighten their lending criteria. And that's widened the demand for non-bank lending. So the reason I say that is because it's absolutely right, David, that we do have increased competition. There's the continually new entrants coming into the non-bank lending space, but that non-bank lending space is very large and growing, and we believe a permanent space. In fact, in Australia, the non-bank sector is materially smaller as a proportion of the total debt market than it is in bigger markets like the US. So yes, there is more competition, but at this stage, certainly where we sit today and where I see things in the short to medium term, there's more demand than supply, notwithstanding that greater level of competition. The way Wingate competes in that space is not on price, but rather on understanding the specific needs of our counterparties, of our borrower partners, bespoke structures that make sense, that are specifically designed to address those needs, and flexibility, a commercial approach to things, and the ability to deliver. So our reputation for delivery is one of the key differentiators of our presence in the market.
Great, thank you very much. We've got another question here from Bob Petruni. This is, I guess, a technical question on the WIP fund. Given the underlying investments, there is, that level of illiquidity. How would one exit from a WIP investment, and how long would that take?
Dani, do you want to take that one?
Yeah, sure. So for those who aren't invested with us, WIP is our Wingate Investment Partners Trust. It's our flagship fund. It's got over $1 billion funds under management in the fund at the moment. And as Kane quite correctly says, and as Ron has mentioned earlier as well, the fund invests in a portfolio of secured private debt, which by their nature are illiquid. So the question, and it's something that me and my team always spend a lot of time on when we speak to prospective investors in the fund, is to understand how to get out of the fund should investors so wish. So there's two ways to get out the fund. One's discretionary and one is part of the fund's mandate. The discretionary exit is what we call through our redemption register, is where an investor says, I'd like to get out when the liquidity of the fund allows me to do so. Now, typically, we've got a very high level of demand to get into the fund. In fact, often we have to run a wait list that can sometimes extend over several months. So typically what we would do in those circumstances is be able to accommodate those investors who want to get into the fund, and with the funds, the proceeds, the liquidity, enable the exit of those investors who want to get out of the fund. And this is what we've done really for most of the time that we've had the fund, which means that the exit is quite quick. Usually within a few weeks or maybe a month. But let me say that is discretionary, and it depends on fund managers' views of liquidity and the liquidity that we require in the fund. Typically we've got a lot of transactions that are maturing and new facilities that need to be funded, and therefore we pay particular attention and work very, very hard in understanding what liquidity we need in the fund. And that needs to be balanced carefully, because cash produces no income. So we don't want to have too much cash. And of course, we don't want to have too little cash and not be able to proceed with the facilities that we've committed to. That's in the ordinary course. We do have circumstances though, and COVID being one of them, where we've got certain unknowns that introduce themselves into the fund. So for example, we've had a few projects that have run longer because of delays involved in construction. And that puts some uncertainty around the timing of the cash flows. And that usually means we adopt the mandated approach that we have with exiting the fund. And that's through a mechanism called the liquidity option. And just very briefly over here, not to get too technical, the liquidity option matches an investor's exit with the repayment of the underlying transactions that investor was in when they indicated they wanted to leave the fund. So just from a mechanical point of view, an investor wishes to exit. We take a snapshot of the investments on the day they want to exit. That gets moved into a separate sector. And as and when those underlying transactions repay, we're able to then forward those repayments to the investor. And that may take up to 24 months, depending on the duration of the transactions in the underlying portfolio. What's of interest, Kane, I would like to mention to Bob and anybody else, is that because of the high demand we're seeing now to get into the fund, we have got a couple of liquidity options that are operating at the moment that we actually intend to accelerate the exit. So again, we prefer not to have investors with us that are looking to exit the fund. And we're obviously looking to accommodate investors who do want to get into the fund. So we'll be going out with a notification most likely, not definitively, but most likely over the next week or two, just informing those investors in a particular liquidity option. We do have a couple that will be accelerating their exit. And in that way, they'll be out of the fund in a much quicker time than they initially expected.
Great. Well, thank you very much. That's all the questions we've got time for today. We're just on midday. So I'd like to thank Ryan and Dani for their time, and everybody listening at home. I hope you've gained some valuable insights and enjoyed hearing about Wingate and their Partners Fund. If you've got any further follow-up questions or would like more information on Wingate, then please feel free to contact us and we'll be happy to help. Now, this is actually the final Fund Manager webinar for the year. We'll be commencing these again in February next year. So we'll be sending out invitations early in the new year. So yeah, keep an eye out for them. But thank you again for listening, and I hope you all enjoy the rest of your day.
Thank you, Kane.
Well, thank you very much, Kane, and thank you to Will and everybody else at Hamilton Wealth. Have a very, very good end of the year.
Great. Thanks, everyone. Bye.